And without further ado, I will give floor to Dr. Rita Bairros, who is a legal expert who has been working for the Bank of Portugal since 2005 and leads now the Payment System Regulation Division, where provides legal advice under the Portuguese and European Payment System and Payment Services Framework, and will speak on the licensing principle and innovation in payments.
So good morning all, good morning to the audience, and first of all let me thank the organization for the opportunity to present here today representing the Bank of Portugal and to provide our point of view on the topic of the licensing principle and innovation in payments. And thank you to my fellow panelists, of course, with whom I've learned a lot today, and I still will along the day. So I work for the Payment Systems Department. We hold some of these topics very dear, and I hope to give you some practical view on the topic here today. So for the agenda, I'm talking about a bit payment systems and some general remarks on what they are and what their importance is for the economy, and a European legal framework for the payment services that is in force today. To give you an overview also on the authorization procedure that Banco de Portugal is tasked with, and some slides on new business opportunities that we have seen arisen after the Payment Services Directive 2 has been published. So, payment systems, they are funds transfer systems with formal and standardized arrangements and common rules for the processing, clearing, and settlement of payment transactions. They are a set of instruments and procedures and rules for the transfer of funds between participants, and they include the participants and the entity that actually operates the arrangement. We have retail payment systems and we have large value payment systems. This is very technical, but just to tell you the difference. Retail payment systems, they are funds transfer systems that typically handle a large volume of transactions, but with a low value in such forms as checks or direct debits or credit transfers or card payment transactions. And then you have large value payment systems, which are funds transfer systems that typically handle large value and high priority payments. And these may be operated by central banks, and in fact in Portugal and the Eurosystem they are. And as you may understand, payment systems, they facilitate the monetary circulation and the transactions between economic agents, and consequently they foster the economy. They allow for the implementation of a single monetary policy, which in the Eurosystem, as you are also aware, is implemented by the ECB, and they of course play an important role in European integration. As for the European legal framework for the provision of payment services, what I would like you to take from this slide is that prior to 2007, we didn't have any common framework for the provision of payment services in Europe. So we had different legal instruments for different types of payment instruments, but we didn't have a legal framework that enabled a single payment market, and we didn't have a way to actually take advantage of the fact that we had a single currency. So we had a single currency, but we didn't have single payment instruments to work with. So it was very important to us and for the single payment markets that in 2007 we had the first Payment Services Directive that here in Portugal was transposed in 2009 by the first Portuguese legal framework for payment services and electronic money. Then in 2009 it was published the second e-money directive, which in Portugal we decided to transpose by amending the first Portuguese legal framework for payment services and electronic money, thus making it the electronic money also framework, because if you care to look at the Electronic Money Directive 2, you will find out that it has many references to the Payment Services Directive. So it's almost difficult to read without having the Payment Services Directive on the side. So this is why in Portugal we decided to merge the two frameworks, and we, as from 2009, had a framework that had the provision of payment services and the issuance and distribution of electronic money. Then in 2015 came PSD2, the Payment Services Directive 2, which is the main payment framework that we have here today and here in Europe and in Portugal, of course. We transpose Payment Services Directive 2 in 2018 by again amending the payment legal framework for payment services and electronic money. And this is the piece of legislation that I want you to focus today. So the Payment Services Directive 2 had three main goals: to foster a single market in payment services, to enhance security and efficiency, and to foster innovation and competition. And this is because we saw, from the first Payment Service Directive to the second, new players coming to the market, new types of business models, and also the need for more security and to foster competition between all these players. So Payment Services Directive 2, what it did was it regulated new payment services, it implemented strong customer authentication requirements, it also applied enhanced user protection and limitation of charges for the PSTU, the payment service user. I will not focus on all these topics, but just to give you a highlight on what strong customer authentication is, you may be aware. So strong customer authentication is basically the need that your account servicing payment service provider, and this is a large name for the bank where you have your account, the bank that holds your account, whenever you access your account online, whenever you initiate an electronic payment transaction, or whenever you carry out an action through a remote channel that may imply a risk of payment fraud, this is the large one, which is more difficult to interpret and apply. Whenever you have one of these three actions, your account servicing payment service provider, they have to ask of you strong customer authentication. So you have to have two or more elements of security of different categories. Of knowledge, they will ask you something only you know, and this may be a password, for instance. They will ask something that only you possess, which may be, for instance, a cell phone, a card, or a one-time password. And they may ask of you also an element of inherence, which is something only you are, such as your fingerprint or your face recognition. And this is a very important feature of Payment Services Directive, one of those that is very dear to the Bank of Portugal. And it came with the different players and the more competition. We also had to have more security and the need for the consumer to feel confident in being able to use all these payment services that are in the market today. As for the payment services that are regulated under PSD2, you have the usual ones, let's say from 1 to 6, and they include, of course, services enabling cash to be placed on a payment account or withdrawn from a payment account, execution of different payment transactions, issuing of cards or payment instruments, and acquiring of payment transactions, and money remittance. But the novelty here is, in fact, the two last payment services, which are payment initiation services and account information services. So what you see in the slide is, let's say, the usual or normal setup of the business model of what the payment initiation service is. You have the user. The user chooses to initiate a payment via a payment initiation service provider. The payment initiation service provider applies strong customer authentication, or strong customer authentication is applied when the payment initiation service provider initiates the payment accessing the user's account. Then the user's PSP executes the payment to the merchant. And what you see there on top is something that doesn't always happen, but which is actually the value added of this business model, is that the payment initiation service provider is able to confirm to the merchant that the payment has been done. So payment initiation services are services to initiate a payment order at the request of the payment service user with respect to a payment account held by another PSP. And this is what is actually new, is that this payment service provider that you see in the middle, they access your account with another payment service provider. This also happens with the other new type of payment service, which is the account information service. These are online services to provide consolidated information on one or more payment accounts held by the user, either with one or more than one PSP. So here, the user explicitly consents to the account information service provider to access their account. Then the account information service provider accesses the various accounts that the user has within other payment service providers, applying strong customer authentication, and then returns the information to the user in a consolidated form. This is also, and we'll see later on, this is also the normal setup for this business model. Just to give you an overview of what this means for entities. So you have credit institutions which have a general license to provide services, payment services, and they do not need a special license to provide these services. Then you have e-money institutions that have a license to issue and distribute e-money, but also to provide payment services. And their prudential framework, you'll find it in the Electronic Money Directive that we just talked about. And then you have payment institutions which may provide payment services, and they have their prudential framework in the PSD2 in these days. Our account servicing payment service providers, the ones holding the accounts, are credit institutions, e-money institutions, and payment institutions. And then what we call the third-party payment service providers, the one accessing those accounts, are the ones to the right, payment initiation service providers and account information service providers. And we will see later on why we have account information service providers a bit out of the image. So this is what open banking actually is, and I'm sure you've heard about open banking. Open banking is nothing more than the banking practice that provides third-party financial service providers open access to data, to consumers' banking, transaction, and other financial data from other financial institutions. And this is usually done through the use of application programming interfaces, APIs, which I'm also sure you've heard about. And this is what we are talking about, a new type of organization where you have payment service providers that hold the accounts and payment service providers that access those accounts and still provide payment services. They do not hold accounts, but they are able to gather data from those accounts. Of course, this is everything is done with common and secure communication rules. PSD2 also catered for this, so we have common and secure communication rules that actually applies from a delegated regulation from the European Commission, and this enables this environment to be secure all over. On the bottom you have technical service providers, which are not payment service providers, but we thought that it was important for you to understand that because they support the provision of payment services, they are pivotal, they play a pivotal role in this environment as well. As for authorization, we have as I told you before, credit institutions, electronic money institutions, and payment institutions providing payment services across Europe and in Portugal. And then you have account information service providers, which are not payment institutions, but they also have to apply for a registration within the central bank. So the Portuguese market is very heavy on payment institutions and e-money institutions providing their services from across the EU under the freedom to provide services here in Portugal. But we also have some payment institutions and electronic money institutions that have been licensed here. We have the principle of exclusiveness, so only the payment service providers that are mentioned in our legal framework are able to provide payment services, and these are the ones you see there, but also some others, just for instance, the post office tier institutions may also provide payment services in Portugal. As for the authorization procedure, I will not go through all the elements, but just to tell you that, of course, as my fellow colleagues have told you today, these institutions, they can only provide payment services or payment service and issuance of e-money. So they have, of course, less risk. And if they have less risk, they have less demanding requirements for their authorization. But still, the process is very strict. We still have a licensing process, of course, and even we cannot, we don't rely only on the PSD2. We also rely on EBA guidelines on authorization of payment institutions, e-money institutions, and the registration of account information service providers. So this is the setup for the authorization of these entities in Portugal. And with PSD2, we even had new requirements added to the ones of PSD1, and these have to do with accessing, of course, to sensitive payment data and transactions and fraud transactions, which is also a very important topic today. I thought about telling you briefly about two articles of PSD2, and those are Article 35 and 36, just very briefly to say that payment institutions and in-money institutions, they are able to provide those services and they have to go through a licensing process, but they still they still have to rely on a credit institution in some aspects. So, as for the accessing to payment systems, there is a rule on PSD2 that says that rules on access of authorized or registered PSPs to payment systems have to be objective, non-discriminatory, and proportionate. However, as per the Settlement Finality Directive, only credit institutions can directly participate in designated systems. And this is understandable because these institutions are smaller, and the Settlement Finality Directive cares for the security of payment systems and what to do in case one of these institutions that participate in the systems goes insolvent. So this is understandable, but in Portugal, as I told you before, we have a retail payment system, and it's owned and operated and regulated by the central bank, and this is SICOI, the Interbank Clearing System. And because our Portuguese transposition of the Settlement Finality Directive allows for this, we allow payment institutions and in-money institutions to participate indirectly in the system. So this participation means that they have to participate through or via a credit institution. So this means that they have to be partners in business. What the Payment Services Directive says is that there is no cherry picking for credit institutions. That is to be said that if a credit institution already allowed for a payment institution to participate in the system through them, they may not say to another payment institution, of course within the same conditions, which is difficult to prove, that they may not. As for Article 36 is a bit more of the same. So payment institutions and in-money institutions, they have access to credit institutions' payment account services. So they should be able to open an account. It's as simple as this. And this opening of the account is very important for the payment institutions to provide payment services in an unhindered and efficient manner. What we see happening in Europe today is something called de-risking, which is basically where a financial institution takes a decision to refuse to enter into or to terminate business relationships with individual customers, most of the times associated with higher money laundering and financing of terrorism risks. So what we see, and what the EBA has found in a recent opinion that was published in January this year, is that de-risking occurs across the EU and affects different types of customers, and it affects payment institutions and in-money institutions a lot. So what we see is this unwarranted de-risking. Credit institutions not wanting to open accounts to these types of smaller institutions because of allegedly money laundering risks, but we should not. We should be careful and be cautious of unwarranted de-risking. As for new business opportunities, these are only some examples that we thought about bringing because this is what we see in our day-to-day life. So we thought we have already talked about big techs, and of course you have heard of GAFA, Google, Apple, Facebook, and Amazon. And these have also positioned themselves as payment service providers after the PSD2 was enacted. And this is very important because these big techs, they already have a large client base, and if they add payments to this, then they are almost unstoppable, so they are able to close the circle in the way they provide services. So it's not only that they provide, let's say, transportation or housing accommodation services, is that they can also deal with the payment service provision that is always connected with the principal type of business. And this is what open banking is. This is very important, and this is what the PSD2 brought us. And you see there in the graph, after the implementation of PSD2, how many of those big techs have applied and got an authorization to provide payment services across Europe. And this is why they say that payment data is more valuable to big techs than to banks or to other payment institutions, because they can combine this data with other types of data that they already had because of their principal business model. So this is something we see. Also, we see, so remember the normal setup of account information service providers that I showed you before, where the information was returned to the user. So I was the user, I would use the provision of services of this account information service that accesses the accounts that I have in other PSPs, and then the information was returned to me. What we saw is that entities are very clever, and they want to build upon what the regulation gives them. So we saw that account information service providers were providing the data they gathered to third parties and not only to the user. And the EBA has also acknowledged this and actually said that this is okay. ISPs, they can transmit the consolidated information to a third party, of course, if the user consents to this, and usually they do. And this is what we call licensing as a service. So this is enabling PSPs to serve as a regulated partner for firms that are looking to offer or use account information services, but without acquiring a license to do so. And this is something that we see a lot in the market, and this happens for audit firms or accountants or ERPs or even credit scoring performers. They want to have access to the information, but they don't want to apply for a license for the central bank. So they go to the services of this account information service provider that uses its license as a service. As for the exclusions of Pst2, and this is, I'm almost finishing. Of course, as you understand, the Pst2 has a number of exclusions, a very, very large number of exclusions, very difficult to interpret and to apply. And one of the ones that I chose to show you today, and I've told you about them a bit before, are technical service providers. They do not enter into possession of funds, they do not hold accounts, they do not initiate payment orders, and they do not access to payment accounts, but they support the provision of payment services, and this is very important. Our regulated firms, they would not be able to provide their services without the TSPs underlying. So their activities can include processing and storage of data, trust and privacy protection issues, maintenance of terminals and devices, which is something that the payment services industry relies on a lot. And I just wanted to tell that they are excluded from the scope. They do not have to acquire a license, but they are very, very important for the environment. And also one last slide to tell you about another exclusion of the Payment Services Directive, which are limited instruments. And these are instruments that you may be familiar with, because they are instruments that are limited in the way that we can use them. Let's say cards, because most of them are plastic cards. You have instruments allowing the holder to acquire goods or services in a limited network of service providers. And here you have store cards, and you may be familiar with them. These you can only use in a specific chain or specific shop or specific chain of shops. And these are excluded from Pst2. Then you have instruments which can be used only to acquire a very limited range of goods and services. And a good example here is our fuel cards. You can only use them to buy fuel or other related also goods, but let's say fuel, because you can only buy fuel with them, and they would apply for the exclusion because it is a very limited range of goods and services. And lastly, meal cards, as you may know them. So they are instruments valid only in one single member state. They are regulated for a specific social or tax purpose to acquire only specific food, goods or services from suppliers that have a commercial agreement with the issuer. You have some examples there, and because this was one of the most difficult exclusions to apply, different member states interpreted these exclusions in different ways. Also from Pst1 to Pst2, the way these exclusions were referred to in the legislation was a bit different. So in February 2022, the EBA published guidelines to help the NCAs interpret and apply this limited network exclusion under Pst2. And this is what I wanted to tell you. I'm available for your questions.
Thank you